Welcome to this presentation on how to maximize risk-adjusted return of a portfolio. Various measures of portfolio performance and use of asset correlation to increase the performance. Here we'll cover the following aspects. The commonly used measures of risk-adjusted returns of a portfolio. The formula for Sharpe ratio. The most widely used measure for portfolio performance. Characteristics of Sharpe ratio and the methods of increasing the same. How to reduce the portfolio volatility to increase the Sharpe ratio. Mathematical formula for portfolio theory regarding portfolio return and volatility. The methods of using the asset correlation to reduce the portfolio volatility. Graphical depiction of portfolio variance at different levels of asset correlation. Using negative correlation of assets to minimize the portfolio variance. Specifications of modern portfolio theory and maximizing the Sharpe ratio. Concept of capital market line and its methodology. Limitations of Sharpe ratio in measuring risk-adjusted return. The dynamic nature of asset correlation and working around the same. I am Aninda Datta, the presenter. To measure the risk of an asset, investors use various measures like standard deviation, beta, and value at risk, etc. Standard deviation of an asset measures the volatility or dispersion of an asset's return around its average return. A higher standard deviation indicates the higher risk, as assets' returns are likely to deviate more from the average returns. Beta measures the systematic risk of an asset, that is, the risk that cannot be diversified away. It is the co-movement of an asset's return with the market return. Value at risk is a statistical measure that estimates the potential loss an investment or portfolio might experience over a specific time period, with a given probability under the normal market conditions. If a portfolio has a 95% VAR of $100,000 over one day, it means there is a 95% chance that the portfolio's loss will not exceed $100,000 on any given day, and a 5% chance that the loss could be greater. This is a VAR diagram. Here the 95% cumulative probability cuts the returns x-axis at minus 0.82%, which shows that there is a 95% probability that the returns would be better than minus 0.82%. Conditional value at risk, also known as the expected shortfall, is calculated as the expected loss given that the loss exceeds the value at risk threshold. Standard deviation is the most widely used return matrix in the financial theories. The Sharpe ratio is a measure used in finance to assess the risk-adjusted return of an investment. It helps investors understand how much excess return they are receiving for the extra volatility they endure for holding a riskier asset. The formula for Sharpe ratio is the return of the portfolio minus risk-free return divided by the standard deviation of the portfolio. A higher Sharpe ratio is better. It indicates more return per unit of risk. It's one of the most popular and standard measures for evaluating the risk-adjusted returns. Used in modern portfolio theory to identify the optimum portfolio, the one with the highest Sharpe ratio for any given level of risk. Maximizing the Sharpe ratio means increasing the excess return, that is, return over risk-free rate per unit of risk. Increasing returns without increasing risk, or reducing risk while maintaining returns. Use modern portfolio theory to find the portfolio mix that lies on the efficient frontier, maximizing return for each level of risk. Minimizing transaction costs and timing entries exits to increase the returns without increasing volatility. One widely used method of increasing Sharpe ratio is to reduce portfolio volatility. Now let's evaluate the broad methods of reducing portfolio volatility to increase the Sharpe ratio. The following is an illustrative list of methods of reducing portfolio variance. Diversify the portfolio. In a stock portfolio, include sectors having low positive correlation between them. Diversification reduces unsystematic risk, company or sector-specific risk without sacrificing the expected return. Combine assets that have low correlation with each other. Example, stocks plus bonds plus real estate plus commodities, or having negative correlation like equity and gold. Use assets or strategies with low standard deviation of returns like money market funds as those of low duration. Include hedging instruments, that is buying in-money put options to delta hedge long shares of commodities. Hedging reduces delta of the portfolio, thus reducing volatility. Consider risk parity strategies, that is weighing assets as per their volatility to achieve the target portfolio volatility. CAPM considers return to be a factor of only beta, that is systematic risk, whereas in real world returns are driven by many factors. Consider factor investing, that is momentum, value, quality, also are factor driving returns to increase the Sharpe ratio. Borrowing at a low fixed rate and investing in high Sharpe ratio securities could increase portfolio return without increasing portfolio volatility. Portfolio theory says that by combining assets with low or negative correlation, adjust the asset allocation to reduce the portfolio variance and enhance the risk-adjusted returns. Suppose there is a portfolio of two stocks A and B. The portfolio return is given by weightage of asset A multiplied by return of asset A plus weightage of B multiplied by return of B. W and B, A and B are the weights of stocks A and B in the portfolio. W and WB equal to 1. The portfolio variance is given by the formula weighted square multiplied by standard deviation square of portfolio 1 plus weighted square plus standard deviation square of portfolio 2 plus W1 2 into W1 into W2 into correlation between the two assets into standard deviation of 1 into standard deviation of 2. It is clear that from the formula that portfolio variance reduces only if the correlation is less than 1. If the correlation is 1, then the formula becomes weightage 1 into standard deviation 1 plus weightage 2 into standard deviation 2 square. The portfolio variance is the square of the weighted standard deviation of individual securities, so there is no benefit of diversification. However, a low positive correlation or negative correlation between the asset returns reduces the portfolio variance as evident from the formula. A negative correlation between the asset returns will reduce the portfolio variance the most. If the correlation is -1, then the portfolio variance formula becomes this, which is equivalent to A minus B whole square, where A is the weight into standard deviation of portfolio 1 and B is the weight into standard deviation of portfolio 2. Let's evaluate the portfolio variance for two stocks portfolio at different weightage combinations at three different correlation levels, positive 0.5, 0 and negative 0.5 between two stocks. These are the returns and standard deviation figures for two stocks, stock A and stock B. This graph depicts the portfolio standard deviation for various combinations of stock A and stock B for three different correlation levels between the two assets. As could be seen, the yellow line depicts the portfolio standard deviation when the correlation between the two assets is -0.5, and this portfolio standard deviation is at the lowest as compared to the other two portfolio standard deviations. The maximum portfolio standard deviation for all weightage combinations for stock A and stock B for three different correlations is less than 14%, which is the standard deviation of stock B. The portfolio volatility curve for negative correlation of -0.5 is at the lowest level for all the weightage combinations. Thus, asset diversification leads to reduction in portfolio volatility as long as the correlation between the asset returns is not 1. As the correlation between the constituent assets returns moves from +1 to -1, volatility of the return of the resulting portfolio decreases. For a negative correlation between the two constituent assets, the resulting portfolio variance becomes 0 for a specific combination of weightage of assets. This graph shows the return and standard deviation and weightage of two stocks in a portfolio. This shows the portfolio variance correlation matrix for a fixed weightage portfolio. The x-axis shows the correlation between the two assets returns, and y-axis shows how the portfolio variance changes with the changes in this correlation. Just say when the correlation is for a specific combination of the weightage, then this portfolio variance becomes 0. If the correlation is -1, then the portfolio variance formula becomes A minus B whole square. For 0 portfolio variance, A equal to B, that is A is the weightage 1 multiplied by standard deviation of the stock A, and B is the multiplication of weightage and standard deviation of stock B. So wherever both are equal, the portfolio variance becomes 0. Theoretically, the portfolio variance becomes 0. That is where the ratio of weightage is equal to inverse ratio of the standard deviation. The portfolio variance is 0. Therefore, the portfolio variance for this portfolio is taken at 0.65% for W1 and 0.35% for W2. That is the weightage at which the portfolio variance becomes 0. However, the 0 variance is theoretical, as volatility and correlations are dynamic and don't remain static. The portfolio variance formula contains both variance and covariance terms. The variance terms increases the portfolio volatility. However, as we add more assets to a portfolio, more number of covariance terms than variance terms get added to the portfolio volatility formula. The number of covariance terms is given by the formula n square minus n divided by 2, where n is the number of assets. Thus, if the new covariance terms are low, positive or negative, the portfolio variance reduces with increase in the number of assets. The modern portfolio theory is a method that can be used by risk-averse investors to construct diversified portfolios that maximize their returns without taking unacceptable levels of risk. The modern portfolio theory can be used to diversify a portfolio in an order to get a better return overall without a bigger risk. An efficient frontier. An efficient frontier is a set of investment portfolios that are expected to provide the highest returns at a given level of risk. A portfolio is said to be efficient if there is no other market portfolio that offers higher returns for a lower or equal amount of risk. The efficient frontier is a curved line. Here initially there is increasing marginal return to risk till the curve reaches a point of highest Sharpe ratio. Thereafter the curve gives a diminishing marginal return to risk, because every increase in risk results in relatively smaller amount of additional returns. Capital market line is a tangent drawn from the risk-free asset to the efficient frontier curve and touches the curve at point of the highest Sharpe ratio. So the slopes of the capital market line is equal to highest Sharpe ratio to the highest Sharpe ratio of the efficient frontier. Just see here, this is a risk-free return point on the y-axis, and if you draw a tangent, then it cuts this efficient frontier at this point, and this point the slope of the line is equal to the Sharpe ratio. So this point in this portfolio on the efficient frontier is the highest Sharpe ratio. Further below the efficient frontier and individual security lies the risk-reward proposition of the security is more advanced. The correlation between the stocks and between the asset classes is dynamic. If the portfolio has 3 stocks, it will have 3 variance terms and 3 different covariance terms. If the portfolio has 4 stocks, then it will have 6 different covariance terms in the portfolio variance formula and 4 variance terms. That's 1 variance term and 3 covariance terms get added by increasing just 1 stock. Thus, if the new stocks have low volatility and low correlation between the existing stocks, the volatility of the portfolio reduces. Thus, if the covariance terms are negative, the portfolio variance reduces sharply with increase in N, the number of assets. However, if the correlation between the stocks is dynamic and the changes with the macro environment, as the betas of the stocks change with the economic cycles. During the economic crisis, the volatility of all stocks generally increases and positive correlation between the individual stocks increases, thus increasing the portfolio variance. The correlation between the stocks also change due to changes in inflation, GDP growth, sector rotation, geopolitical tension. The dynamics of correlation could be managed by using rolling correlation, using moving periods, say 6 months, short-term correlation matrix for comparison with long rolling period correlation. Clustering methods could identify stocks, those could move together. This is just an illustrative list. The Sharpe ratio is the most widely used risk-adjusted method to measure portfolio performance. As portfolio volatility is the denominator in Sharpe ratio, so reducing the volatility is highly effective in increasing the Sharpe ratio. Sharpe ratio assumes that volatility captures all risks. If volatility fails to reflect all risks of an asset, then Sharpe ratio may not be completely reliable. A common inference is if the returns are not normally distributed but have a strong skew, then Sharpe ratio is not accurate. In case of asymmetric returns, omega ratio is more accurate. The monthly returns distribution of Standard & Poor's 500 for last 50 years is quite normal and is given in the following URL. Multi-asset class portfolios generally have higher Sharpe ratios than single asset class portfolios. As low positive correlation or negative correlation is more common between the different asset classes, so resulting portfolios have lower volatility. Economic and market conditions affect the inter-asset class correlation. The biggest challenge in multi-asset class portfolio construction is to predict the future returns, volatility and inter-asset class correlation. In the next episode, we'll examine the historical returns, volatility and correlation between asset classes under different economic and market conditions. So this concludes this presentation. Thanks for watching.